Welcome back to another Market Insight, joined by Aaron Tuttle as always. This is going to be a longer one. We're talking politics, and there is a lot to talk about. You know, we agreed to do this before there was an assassination attempt, before President Biden stepped out of the race. But luckily, Steve Chiavarone still joined us today. Steve, thanks a lot for being here.
Thanks for having me.
Steve is a senior portfolio manager at Federated, a $750 billion asset manager. He runs several investment strategies, and he directs their economic policy for the firm. Well, I don't want to spend too much time on it because you can get this from your preferred political source, but can you run us through what you're seeing in terms of the map and what it's looking like for the election?
Yeah, well, I mean, it's certainly changed a little bit over the last week. We now have a new Democratic, or at least a presumptive Democratic nominee. We're not necessarily confirmed there. What I'd say is that prior to President Biden dropping out of the race, what you saw was a race that was, on a most likely outcome basis, and I'm talking about not only the polling data, but also the kind of betting odds, that looked like the most likely outcome was a Republican sweep, right? You have Donald Trump leading somewhere 2 to 3 points in the polls nationally, and then leading in each of the swing states. And in fact, he hasn't trailed in any of the swing states on an average of the poll basis in at least 3 months, and in many cases, as many as 9 months. And then a Senate where the math is heavily favored towards the Republicans. You have 23 Democratic held seats up for grabs versus only 11. West Virginia looks all but lost for the Democrats, so that brings you to a 50-50 Senate. And then a number of races where you've got kind of toss-ups, close races, but all in states where Trump has a lead at the top of the ticket. So probably higher odds that the Senate goes Republican, and then you would expect that as goes the presidency, goes the House. The second most likely outcome is if you have a Democrat win at the top of the ticket, whether that's Vice President Harris or some nominee that we don't know today. There's probably enough coattails to take the House where things are very, very close and margins are very, very narrow, but it's probably not enough based on the way the polling looks today to carry the Senate. So most likely outcome is a Republican sweep. Second most likely outcome is divided government led by the Democrats, but with a Republican Senate. And then, since Harris has entered the race, so far at least, and we're in the very early days, I'm sure there's going to be a honeymoon and a bump, and as she's able to make her case, you'll see some tightening of the polls. But at least today, she does not look materially different than President Biden did, right? So she's trailing in the polls by somewhere between 1.5% and 2.5% nationally. She appears to have similar deficits in states like Georgia and Arizona and Nevada and Pennsylvania and Wisconsin. And so I think the story here with the switch, if you will, is that the Democrats are in better shape than they were a week ago when President Biden was still the nominee, but was being inundated with calls to drop out. But they're not where you would want to be. If you were parachuting into this election and your choice was to be a last-minute swap down 2 to 3% nationally and trailing in the swing states, as opposed to being in Trump's position, where you're a well-established candidate with a national lead and leads in the swing states, you'd still choose to be in his shoes.
I just wanted to show that. I wanted to show a couple polls from, again, before the dropout, but just to show how close it was. This is from the Trafalgar Group, which has been a pollster that's been really accurate in the last 2 elections. And to some of the uncertainty, when you look and compare this to where Michigan and Wisconsin were 4 years ago, undecided is still really high. Of course, this was before Harris was the presumptive nominee, and the third-party candidates were still polling at significant margins higher than they were in the past. So I think this is going to show kind of what you were talking about, a little bit of uncertainty in the markets.
What I might add to that, just quickly, is, and people forget this, the 2016 election was decided by an NFL football stadium's worth of voters, right? If you think about that. The 2020 election was decided by a college football stadium worth of voters. You're talking about very small margins here across a number of states. And so a little bit of enthusiasm gap on one side or the other can make the difference. A little bit of tension within the Democratic coalition, right? So when you think about Michigan, which I know you have on that poll, You think about places like Minnesota. The Israeli-Palestinian issue is big in those areas. And so if you're not happy with one, your kind of party's position on that for whatever reason, a little bit of enthusiasm gap that keeps folks home can make up that 1%. So yeah, I think it's going to be tight again, as are most presidential elections. And I think the uncertainty level is higher today than it was 2 weeks ago, because 2 weeks ago, both of the candidates had been president within the last 5 years. Today, that's not the case. One of the candidates has never been president, and that carries with it some more uncertainty.
I would also think this, with Robert Kennedy on the ticket, and if I'm gaming this out, and we look at the last 2 weeks, probably a bump towards Trump, and probably some takeaways where Trump isn't losing any votes to RFK, he's probably gaining them, where now Harris or whoever the nominee is probably giving them up to Kennedy. So back to your college football analogy, I think there's a reason that Democrats don't want him in running.
Yeah, they haven't been all that encouraging of his candidacy. Let's say it that way.
Well, let's move to policy. What are the main differences you see in terms of policy between the two parties?
Yeah, I think it breaks down across 4 lines, all of which have economic implications. So, the first is taxes, starting with the kind of Democrat proposals there. They've talked about, well, let me say it this way. There's an action enforcing catalyst coming, right? The Trump tax cuts, the personal side of the Trump tax cuts expire in 2025. And so something's going to have to be done with those one way or the other. I think that what you'll probably see are the Democrats would extend some provisions of those personal tax cuts, but there's many that they would not, particularly, anything that's perceived as being kind of tax relief for the higher end kind of income earners. Democrats have also floated ideas of things like higher taxes on dividends and capital gains for folks over a certain amount of income or wealth. They've even talked about taxes on unrealized capital gains. I'd like to think that that's election positioning. In the history of ideas, taxing capital gains might be the worst one, or unrealized capital gains. But that aside, so you've got a policy of kind of higher taxes there. I think there is some appetite from the Democrats, although they would need both houses of Congress in order to do this, to increase the corporate tax rate a little bit. Remember, that was cut during the Trump tax cuts, but that part was made permanent, so that doesn't expire. But you do hear some talk about wanting to, bump that up, a few points. Whereas on the Trump side, what he's talking about in terms of taxes are certainly extending the Trump tax cuts, maybe expanding them for certain folks and in certain instances, and maybe even further reducing the corporate tax rate. I know we'll talk about tariffs next, but there's also this idea from the Republican side of using tariffs as a means of generating revenue, which can then pay for some level of further tax cuts on the income side. So very, very different tax regimes, right? If you were to look at those two kinds of tax plans, I think what you'd see is that all other things being equal, the Democratic plan is one of kind of fiscal tightness on that front. If you assume that spending is the same on both sides, if you raise taxes, that's fiscally contractionary at some level, right? It takes money out of the economy. It certainly takes money out of consumers' pockets. The Trump plan is really more of an expansionary one. So I think the Democratic policy is a little bit worse for growth, but probably a little bit better for inflation coming down. The Trump policy is probably a little bit better for growth, but could carry with it some inflationary elements. And you've seen on days where the Republicans are doing well after the debate or in the wake of July 13th, the yield curve has steepened, right? The 10-year bond has sold off a little bit. And I think it's an acknowledgement that one set of policies are a little bit more pro-cyclical, ones are a little bit more counter-cyclical. On the tariff side, which is the second kind of key element of policy, you're probably looking at relatively status quo trade policies if it's Harris or some other Democratic nominee that wins the presidency. Maybe a little bit more on Chinese steel, but generally the kind of similar trade policies. Trump's talking about, and I think while the best thing I've ever heard about thinking about Trump's policy proposals is you should take them seriously, even if you don't take them literally. So He may not go all the way on these policies, but to brush them aside and say he's not going to move in this direction would be a mistake, I think. So he's talked about a 10% across the board tariff on imports. It's unclear as to whether or not that includes or excludes countries where we currently have free trade agreements. He's talked about 60% on Chinese imports and 100% on the importation of foreign cars. So a significant kind of change in tariff policy. And that carries with it some negatives and some positives. So the negatives are, clearly that would lead to an increase in prices, right? You can have goods being more expensive to be imported. However, I think about a foreign car maker, a Japanese car maker that is using Chinese components and assembling a car in Mexico, right? They assemble the car in Mexico because then it gets shipped in as a Mexican import, which is not tariffed under the USMCA. Under this tariff regime, that would no longer be possible. That car would be hit with as much as 100% tariff. I'm fairly certain that Japanese automakers aren't just going to say, well, we don't need to sell cars in the United States anymore, right? Instead, that factory now has to be in Alabama. And I love Alabama. It's a wonderful place. But you know what we don't have enough of in Alabama? Everything. We don't have enough natural gas pipelines and utilities and factories and restaurants around the factories and multifamily homes around those factories. And so if all of a sudden that Japanese car maker needs to go to Alabama, that needs to be built. And that's going to be financed by smaller local banks. You're going to use local construction companies. My dog didn't like that idea. Local construction companies. There is a benefit to that on the other side. Whereas on the Biden policy or the Harris policy, you're going to have cheaper goods, you're going to have better trade relations, and multinationals are going to be favored in that scenario. So large caps better in one, small caps better in the other.
Let's pause on the multinationals, because I think we had a great example of this probably last week, where semiconductors in a single day, the index is down about 7%, about 30% of their revenues domestic. And that was a day where we had some Trump tariff announcements and some trade restrictions from the Biden administration restricting some of that trade. Not uncommon. We see it a lot. NVIDIA will go down 2% on trade restriction days and seemingly recover in the next day or week. So the question is this campaigning? Do you see it as a real risk? Or is it noise, good management works their way through it, and it's just the headline to headline?
I think that bigger things ultimately determine asset prices, right? It's the long-term structural health of your business. It's interest rates, it's inflation, it's demographic growth, it's the demand for your products. Those are the big long-term drivers. Politics matter. It matters. I'm not telling you it doesn't matter, but it's not going to take a successful stock and make it unsuccessful. And I've always said, one of the reasons why, and we manage multi-asset portfolios, but we have a bias towards owning more equities. And at the end of the day, if I have $1 to give, I'd rather give it to the 500 CEOs of the S&P 500 than the 435 members of the US Congress, when I think about kind of stocks versus a treasury bond as an example. However, I think we have seen very clearly that the entirety of the Democrats' agenda over the last couple of years has been quite beneficial for large caps and not as beneficial for smaller caps, right? We haven't talked about it yet, but regulation is tougher on a smaller company to be able to afford relative to a larger company. Large companies engage in more trade, especially when you get into the tech sector, right? The big Mag 7 tech companies, it's not uncommon for over half of their revenue or more to be generated outside the United States. And so anytime you have a disruption to that, that's going to incrementally benefit or kind of hurt them. Anytime you have more regulation, it helps the big company because it kind of locks them in, right? They're locked into their advantage because only they can afford that regulatory apparatus. The smaller companies can't, and so they're less likely to get disrupted. A Trump presidency is less friendly to that because he is going to do more on trade. I don't know if it's 10 and 60 and 100 on the tariffs, but I can tell you it'd be more than it is today. And so you do run the risk of retaliatory trade policies. he generally is about less regulation. And we'll talk about that in a second because it really impacts certain sectors. But that then unleashes more opportunity for kind of smaller companies. So it's not that one's necessarily better than the other. I'm not making a value judgment here. But I am saying that I do think you will see, as interest rates fall, because that also benefits smaller companies and things that are not tech and large caps. But also, if this election continues to break in the favor of the Republicans, then I think the dominance of large cap growth will be less so. And I think you'll see a broadening out of the equity rally, much more to value and small caps, as we go forward. I don't think it was just a one-time blip.
On that tax and tariff policy, you're saying how they're different, and I'm a libertarian, and I think Chris is as well. We kind of flipped for who was wearing blue and red, and when we flipped the coin, CEO won over CIO, so he's the Democrat. But I feel like we're arguing over the difference of Pepsi and Coca-Cola, right? We're talking about the tariffs that the Republican wants to bring in versus the higher capital gains tax that the Democrat wants to come in. Sure, there are going to be asset classes that are going to be favored, and I agree with everything that you said, but really on the economy, broader economy, not asset class, is there a big difference between these? We're not arguing Milton Friedman versus Keynes or Samuelson at this point. We're somewhere in that middle. I always feel like it's left of center versus right of center.
So this kind of leaves the realm of economic policy a little bit and gets more into the realm of political stability. I would agree. I don't think, unless you were really talking about taxing unrealized capital gains, right? If you go there, that's very different. And I use the John Dutton example there, if you've watched Yellowstone. So, he's got this huge ranch. Let's say it's worth $14 billion. Let's say he has $100 million in liquid assets. And let's say that ranch went from $10 billion last year to $14 billion this year, and you're going to hit him with a 25% tax. You're going to charge him with a $1 billion tax bill, and he only has $100 million of liquid assets. He's got to sell the ranch, or at least a portion of the ranch, to make that bill. And if every billionaire rancher has to sell at the same time, they're not going to be able to do it. So you are now in the realm of property seizure. It's the only way that you can handle that. If that is a realistic policy, then I think the statement that you just made is wrong, that we're talking about very, very different economic policies. I don't think that's actually on the table in a real way. And so I would agree with you that we're talking about on the edges here. Where I do think, though, these two parties represent very different economic environments is in the level of certainty, right? If you do things like get rid of the filibuster in the Senate, or you do things like create a precedent in terms of packing the Supreme Court, where if you don't like the mix, you just kind of change it. It then creates a scenario where one party can vastly, easily, and significantly change policy without any need for negotiation with the other side and without any worry that a Supreme Court is going to kind of push back. That would materially impact the economy, in my view, because companies value more so than anything else a certain environment. That policy today is likely to persist so that I can plan, I can go about long-term capital planning. If you were to create a scenario where every time you have an election change, you could get wholesale, massive, economy-wide policy changes, companies are going to have a very, very different reaction function. So I do think the parties are different, but I don't think it's necessarily, in a significant way for the economy. But I don't think it's so much in terms of economic policy. I think it's much more in terms of these structural institutions and how we approach those. And I also think immigration represents a critical difference. How much immigration you have, where you have it in the country, and the origin of that immigration can really change long-term political trends, economy, skill sets. I mean, that demographics are ultimately destiny. And so I think that's also an area where you've got significant differences in terms of how the parties want to handle it.
I think those are all interesting points. And to your point, that a lot of that is not priced into the market. So it introduces risk. It probably shouldn't be priced in a significant way because it's low probability. But that is a risk, because if that does start to bring itself up as higher probability, it needs to be priced into the market. So I did want to move back, because you did say small caps, which is a very interesting asset class to us, and it relates to another slide you had in here, which is the debt wall, something we've been talking about the last couple of years, because the debt wall of maturing debt for large caps has not been a problem. We see in your chart that in 2025 we start to see a pickup, but currently in 2024, not a whole lot of debt that needed to be refinanced. In your note, you had that they did a great job during the ZIRP period of terming out their debt. But that can't be said for small caps. If you look at a percentage, about 2 times the amount of debt is coming due in the next 5 years for smalls relative to large cap. And about 3 times is actually floating rate debt for small caps. They do need interest rates to come down a little bit for some of that interest expense. So how are you approaching the small caps as an asset class and the interest rate forecast for that?
Yeah, so when you look at the S&P 500, roughly 10% of the debt of S&P 500 companies is floating rate debt. The vast majority is fixed rate debt, right? They go out, they issue a fixed rate bond with a kind of fixed term, usually about 8 years out, and that's how they finance themselves. When you get down to the Russell 2000, that number of floating rate debt is somewhere between 30 and 50%, so 3 to 5 times higher than where it is in the S&P 500. By the time you get to a small business, think about your local mechanic or pizza shop or whatever your kind of local small businesses are. Almost all of that debt is variable rate debt, right? It's akin to going out and getting a kind of credit card, if you think about it that way. And so when rates were rising and the Fed was hiking rates, they didn't need to worry about a debt wall. It was repricing higher every single day, right? The rate goes up, their debt yield goes up. I mean, if anyone on the call has a credit card, look at your statement, look at what your interest rate is today, and compare it to what it was when you took out the card. It is a rate that will make a loan shark blush. Okay? The reason that wasn't so painful for small caps, so it was certainly painful for their stock prices, but it wasn't so painful in terms of kind of defaults and bankruptcies, and we haven't seen a kind of cascade of failures among small businesses, is they were able to tap into an enormous amount of government stimulus, even over the last 2 years. So if you remember, there were programs during the middle of the pandemic where if you shut down but you didn't fire anyone, the government kind of gave you money. Those programs were live until January of this year. So last year, about $350 billion went out to small businesses in that program. This year, it's about $400 billion. So even though their interest expense, their interest rate went from 5.5% to 10%, they were able to access this money and get through. When rates start to fall, small caps are the immediate beneficiary because then that debt starts to reprice cheaper immediately. And so small caps have this very, very interesting place in the asset class world where they really are the nexus between being economically sensitive and interest rate sensitive, right? They're both cyclicals and interest rate sensitive names. And so if you look out, you could be setting up for a perfect storm for small caps in a positive way, right? And here's how that would play out. One, the economy is slowing, but it doesn't get terrible. We don't go into a recession. In our base cases, we do not. And so the economic growth is okay. It's good. It's fine. And that helps them on a cyclical side. The Fed is still able to cut rates in that environment. And yeah, it's only going to be 1 or 2 this year. But once they start cutting, we think what the market's going to realize is that they're going to likely go from a 5.25% federal funds rate to something like 3, 3.25, 3.5 over the next couple of years. Well, that's a meaningful decline, right? And so small caps should then also very much benefit from interest rates falling. Add on top of that, if you have a scenario where you've got a Republican administration with lower personal tax rates, remember, the poorest small businesses pay the same tax rate as the richest individuals, right? Small, very small companies most often pay personal tax rates because they're S corps. So when you tax the rich people, you're also taxing the poorest businesses. So any extension of the Trump tax cuts is going to be a benefit for the very smallest companies. Deregulation will take some pressure and expense off. And if tariffs encourage more domestic production, that generally tends to favor small caps. So you could have this perfect storm of interest rate, economic growth, and political change, all benefiting small caps in the fourth quarter of this year. That's interesting to us.
What other conclusions do you have? So we went through all your policy slide. What other, you manage several different strategies at Federated. Are you making any changes specific to policy we've discussed?
Yeah, I think the first thing you had to recognize is that when you woke up on Monday of this week and you had a new presidential, or President Biden was no longer running for office, it fundamentally changed not only the way you need to think about the election politically, but also economically. A week ago, the two candidates for president had been president within the last 5 years, right? We had lived through both of them recently. And it is an absolutely objective truth that under both President Biden and under President Trump, the S&P 500 hit a record high. And under both President Biden and President Trump, the unemployment rate hit a 50-year low. And so while there were certainly certain parts of the market that you might think would do better than the other, there was no uncertainty premium that had to be built in. Remember, investors in stocks are more comfortable being certain about something bad than they are being uncertain about something that could be good. The certainty matters more than whether or not the thing that they're uncertain about is good or bad. And so there was a lot of certainty around the economic policies of both candidates. That's no longer the case, right? We believe that Vice President Harris has a similar agenda to President Biden. However, if we look at her campaign in 2019, she did appear to be, quite a bit further to the left than President Biden on a number of issues, not least of which were immigration or tax rate policies. Now, was that posturing? Was that, electioneering? Is that really her? We don't know. So the point is we're now in an environment of greater uncertainty. So the first thing that we recognize is we're likely to see more volatility in the market than we would have otherwise. We think we'll see a kind of back and forth between that Trump trade and that Harris trade, right? So last week, before the dropout, you saw small caps outperform. It was a 5 standard deviation event. You saw the yield curve steepening. You saw value outperforming. You saw those semis underperforming, the way that you had mentioned. This week so far, 3 days in, you're seeing a little bit of the empire strikes back, if you will, right? The large caps are outperforming, growth's outperforming, the yield curve is flattening. So I think with greater uncertainty, you're going to see kind of back and forth between those two trades. In terms of what we're doing in the portfolio, we always start by making portfolio decisions based on things that aren't politics, right? So we think we've got an economy that's stable but slowing. We think we've got valuations that appear very stretched in certain places and maybe not as demanding in others. And we think we're on the verge of a rate cut cycle, right? And so what that means for us is we still want cash to be a meaningful part of our portfolio, but not an overweight. We need to start to extend some duration, and we are. That means a little bit on the short end. Think of the ultra short space, the 1 to 3 year part of the curve. Some in longer term bonds, that kind of 5 to 7 year part of the curve. Within equities, we did take our equity overweight down a little bit. We were about 5% overweight. We brought it down to 3 in recognition of greater volatility, but also a little bit of signs of kind of overpricing in certain parts of the market. We trimmed large cap growth, trading at over a 30 times forward multiple. We've only seen 30 times forward multiples when you have during the dot-com bubble and the COVID lockdowns. That's expensive. We are overweight small caps. We are overweight value stocks, primarily because of what we think are going on with rates. But we recognize that if politics go a certain way, that could be an even more advantageous trade. So that's how we're looking. Internationally, I would say we're also watching certain markets. India would be the biggest beneficiary internationally of a Trump presidency because an Indian import at 10% becomes much more attractive than a Chinese import at 60%. And the Indian stock market's been trading along with Trump's betting odds. And so, he's favored at about a 60% chance of winning, and India's doing quite well. Mexico would be the big winner under a Democrat victory because you wouldn't be seeing any change to their zero tariff policy. And you can see that the Mexican stock market has kind of followed those odds. And so those are things that we're watching, but generally speaking, we're making most of our investment decisions based on the big economic trends.
We've made maybe all of those changes that you discussed in our portfolios over the last 6 weeks. So not sure what that means in terms of a counter indicator for signals, but I just want to.
It means we're in this together. That's what it means.
I wanted to put numbers to what you just said. So on the left-hand side of this slide is what happened under Trump's presidency, and same with Biden. And like you said, of course, there's going to be a little extra uncertainty of, is the Harris ticket going to be similar policies as Biden? But we talked a lot about the difficulties for the large cap growth multinationals. Under Trump, that was the best performing asset class. So while you even said it, good businesses will figure out their way and become good stocks as well. And the S&P 500, the general large cap, did very well under both presidents. And small cap, as you mentioned, did a lot better under Trump. So those are the main things I wanted to pull apart on the left-hand side. On the right-hand side is moving past the uncertainty. The day after the election, there's been a rally for both presidents when they were elected. And then the 2 months after the election, when you start to get more of that certainty, significant rally as well. Final point I wanted to show, because we know how tough things can get in the headlines and how things can be in politics, January 6, 2021, call it whatever you want, the stock market was up that day. So I know things can get wild, and I know you've been talking about needing your popcorn ready.
That's right.
But the market has showed to be resilient through these periods.
There's a great line in Jurassic Park, because all the dinosaurs are supposed to be female, and then all of a sudden, you start seeing reproduction. And the line is life finds a way. So does capitalism. It finds a way. Despite what policymakers try to throw at companies in terms of regulation or uncertainty or tax policy or the like, companies find a way. Capitalism finds a way. You adapt. And so I think anytime you've doubted that, you've done so at your peril.
On uncertainty, when I think about, that this is a political show, and every time we do that, we talk about an October surprise. At this point, I think the October surprise is aliens taking over Starlink, telling us that Elon Musk is the avant-garde because they're taking back their historical home planet because they're descended from our dinosaurs. I mean, the entertainment factor, to your point, on stocks is like, you just got to be long popcorn right now because it's just going to be entertaining over the next 4 months.
I never quote Lenin. I'm just not in the business of doing that. I'm a good old-fashioned Wall Street fat cat capitalist, so I don't generally quote Lenin. However, there is a quote of his that's been just ringing in my head over the last several days, which is, there are decades where nothing happens, and then there are weeks when decades happen. We are in one of those weeks. It has been, certainly anything but boring. But again, I think, and we have a study that we show often. If you were to only invest your political preference, right? So if you only own the market when a Democrat was in office, or you only own the market when a Republican was in office, you didn't make a lot of money. If you invested through both of those regimes blindly from politics, you generated a lot of wealth. Put another way, we did a study where you took two hypothetical people, and you gave them each $100,000 on New Year's Eve, 1929. Not exactly the best time to start an investment portfolio, but they put it in the S&P 500. And one of them did nothing. They put the stock certificates under their mattress and kept them there for 90 years. And the other person was an incurable optimist. They bought $1,000 a month of the stock market. And they bought in all periods where they should have known better. They bought during a world war, a Great Depression. They bought during Woodstock. They bought during Tricky Dick twice, Vietnam, Jimmy Carter's sweaters, Bill Clinton's blue dress, the Red Sox winning the World Series, right? Every manner of calamity that you could envision. They bought $1,000. The numbers are striking. The person who did nothing earned a 13,000% return. The person who bought $1,000 a month earned a 92,000% total return. They outperformed the market by 2.5% a year for 90 years. The moral of the story here is there's always something to be worried about, right? There's always a Fed rate cut cycle coming, or there's always economic data that's slowing, or there's always somebody running for office that you think is uniquely unsuited to be in that office. And there's always a bad political idea from somebody, and there's always a war somewhere. At the end of the day, you generate wealth by subjecting money to the compounding of stocks and bonds. That's the story, right? As long as companies innovate and make new things, and you have population growth, and the government is able to repay its debts, as long as those, and companies are able to repay their debts because they're growing, as long as those things happen, you're going to generate wealth over the long run. And so the key is, don't turn a political set of drama or even a political calamity into a personal financial calamity. See through it. Recognize those 500 CEOs and all of the people that they employ are going to figure out a way to make money. And the 350 million Americans are going to continue to have children and invent new things and innovate, and that's going to lead to higher prices and wealth creation. And if you keep that perspective, you just don't get too crazy on the political headlines, which right now is exceedingly easy to get too crazy on the political headlines.
We're running out of time. We're going to end with the game we always end with our guests. It's make a case for an asset class for the rest of the period. So we'll do the end of the year. Can be anything. Jeremy Schwartz actually in January took biotech, which was an interesting call. I think he got tired of being right all the time and just wanted to get a flyer out of the way. That was a bold call. But what's your asset class that you want to take for the rest of the year?
Domestic small cap equities. I think it's the domestic small caps. I think as rates decline, financial conditions ease, the economy holds in, I think they are set. There are 2 standard deviations cheap relative to their history. I think they're going to pop. I think they're going to pop hard. And I think politics could offer even a little bit more of a kind of tailwind there. So it's small cap U.S. equities.
Well, I've always spread my bets like I did at the beginning of the year, small cap and gold, but it's the same theme. I think inflation is going to be higher than what is expected, and both of those asset classes were underpriced for that.
Yeah, I think that's a good call, and to tie in the sectors that we talked about too. The small cap sectors, instead of being 30% technology like the S&P 500, you start to move a lot of that into financials, things that are exposed to a lot of what you talked about today. I can't be consensus. I'm going to stick with the call of large cap, although I do think small cap will close some of that outperformance gap at the end of the year. Thank you for joining us. Go ahead and hit that like button and share it with someone that you think will find it useful. Next month, we'll be back with Jeff Winiger from Wisdom Tree talking about the national debt.